The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. We're talking about index funds. They are so popular, but there is risk. Is your money safe? Joining me now is Philip Diehl, 35th Director of the United States Mint and the President of U.S. Money Reserve. And Philip, I know so many people are involved in 401ks and IRAs, and there's always an option for index funds. Tell us, what are they?
Yeah, they're incredibly popular, and they're popular for a couple reasons. One is the fees are very low on index funds, and the reason why the fees can be low is because really there's no research that is required for these funds, and the service is pretty minimal. And what these funds do, the reason why they can be so cheap in terms of fees is because these funds typically accept investment money and then spread that money across every stock in the index. So, for example, we're going to be talking a lot about the S&P 500 index because that's the big one. That's probably about 80% of the market capital of U.S. stocks. So we're going to be focusing on the S&P 500. And so what that means is that there's no stock picking that goes into it. It's just all the stocks. Every stock in the S&P 500 is covered. And so the other advantage that comes from this is by buying all the stocks, you have a really diversified portfolio. So these are two huge attractants especially for those who really don't want to actively manage their funds. The S&P 500 has performed extraordinarily well over recent years. So the combination of returns, diversification, and low fees has drawn tremendous amounts of money into these index funds. For example, the S&P 500 alone now has $13 trillion worth of market capital in index funds. And that's about 25% of the S&P. So this really represents, the index funds represent a rapid and sustained growth of funds, investments into the S&P 500 that has been very impressive and has impressed investors, not just in the United States, but all over the world.
It's had its ups, also had, I guess, some downs because the S&P 500 fairly stagnant from around 1999 to 2011. So is there any risk about the diversification there and the downside to investing in the index funds?
Yeah, there's a couple of ways to think about it. Is when you're investing across every stock, that means there's no stock picking going on. There's no one in the fund, and by the nature of the fund, is going through and doing the typical analysis of investor sentiment, technical analysis, fundamentals analysis that has been so much a traditional part of stock picking over the years. And so what we have is a situation where at least 25% of the market capital is simply going into all companies without this sort of analysis going on. Now, when there's a relatively small part of the market that is being invested through index funds, then the market is being led by people who are doing that kind of analysis. And people who invest in index funds get the benefit of their work. But when you get up to 25%, then that influence really begins to dissipate, and the value of stocks, especially across the market, becomes unhinged from any sort of traditional assessment of stock values.
I guess it's the old sportscaster in me. I see S&P 500, so I think, okay, my money is divided equally between 500 different stocks. But that's not the case, and that's what we almost have to worry about, correct?
Well, no, they are. It's not equally where each stock gets the same amount. In the S&P 500, it's weighted by the market value of the stock. So really what we have is a situation in which, you're in a different situation if a few stocks come to dominate an index. And in that case, you start to get a little bit concerned if that occurs.
Yeah, how does that happen? How can one industry dominate like that?
Well, what has happened is that the tech industry has gotten to be so hot in recent years that, and this is before the AI boom, it got so hot that it came to dominate the S&P 500. About 35% of the total market cap of the S&P 500 is tied up in only 7 companies. They're called the Magnificent Seven. And those 7 companies represent only 1.4% of all the stocks in the S&P 500. You have 493 other stocks that are 99% of the market that represent 67%. So if you think about this as an inverted pyramid, you have 7 companies at the bottom of the pyramid, and the other 493 are arrayed above it. And anytime you have a situation like that in an inverted pyramid, you've got to be concerned about the stability of it. And NVIDIA, one of those Magnificent Seven, has been extraordinarily successful. And really, among those 7 companies, I'd make that the number 1 company, which is at the tip of that pyramid. So we have a situation in which tech companies dominate the S&P 500. But also, there's another factor here, and that is all of these 7 companies are deeply embedded in the AI, the artificial intelligence sector. And so you have 7 companies that are tied to a single technology with hundreds of billions of dollars being invested. $368 billion in 2025 alone. It'll be trillions of dollars over the next 5-7 years and the last year. So, and really what this raises is questions about how is it possible for these companies to get a return, to make profits on these kinds of investments. And for me, it reminds me of the dot-com bubble. It was a very similar situation with dot-coms, where a lot of companies invested tremendous amounts of money into fiber optic and data centers. And when that bubble burst, there was a lot of blood on the floor. There were, that market died for years afterwards because there was so much excess infrastructure that had been invested in. And I'm highly skeptical that it's possible that all of this trillions of dollars is going to generate a profit for companies. The MIT recently issued a report in which they did a survey of these companies and found that the companies are saying they are not producing any profits yet on these investments and don't expect to in the immediate future. And so I'm an optimist about the prospects for ANI. I've had a little bit of experience with it, and it has knocked me out. how good it is. But that's long term. I think in the short term, there is going to be a shakeout in which a number of these companies, their investments fail, the companies themselves may fail, and then there'll be a few left standing. And so what that means is that with those magnificent seven being so deeply embedded in that A&I business, they're going to be there's going to be a shakeout, and that shakeout is going to shake the entire structure of the S&P 500 and the 401ks and IRAs that are invested in them.
Philip, who are the Magnificent Seven?
Well, we have Alphabet, which is Google. We have Apple. We have Amazon. We have Microsoft. We have Meta, which is Facebook, NVIDIA, and also Tesla. Those are the big ones, and we all know them. I mean, the one that is least well known is NVIDIA. It's the newcomer. It is that chip manufacturer that is just making incredible returns. Last year, their returns were like 273%. It's calmed down this year. I think it's like 40%. They just completely dominate the marketplace, and they dominate the news too. I mean, when you read about what's happening in the marketplace, typically one of those companies.
Yeah, I remember the first time I got involved in a 401k 35 years ago, and someone advised me, oh, get in an index fund. It's very diversified. It's going to be great. But if it's so heavily tech, how is that diversified?
Yeah. Well, it's not. That's the point here, is that the original appeal of index funds, one was the low fee, but the other was the diversification. And we no longer have that diversification in the S&P 500 and the index funds. It's developed in a way where it's escaped notice for the most part. Only recently have I begun to see articles written in mainstream business publications about this phenomenon, this development. And oftentimes it's described as a theory. Well, there's not a lot of theory to it. There's a lot of facts to it. And there are some conclusions to be reached based on those facts. Is it inevitable that the S&P 500 index funds will suffer? Well, there's nothing inevitable except death and taxes, I guess. But I am convinced that a day of reckoning will come. Like I said, I'm a believer in AI. I think it's going to transform the world in the same way the dot-coms did eventually after that initial crash in 2000. But I think we're going to see a crash before we get to that date of transformation.
Well, you've described a stock market dominated by index funds. You've talked about index funds dominated by tech companies. So it seems like you definitely have to play the long game here, because it may take a while to make sure you get through all these bumpy roads.
Yes, that's right. You do have to play the long game. And what you need to do is recognize that you're no longer diversified in the S&P 500. You're vulnerable because you're so heavily invested in 7 tech companies that are all dependent on A&I for their future success. So you need to diversify. Now, one way to diversify is with gold, and gold that's one of the traditional roles of gold, is to diversify a portfolio and to provide wealth protection against hard times. And that's what we're talking about here, is a big market correction, maybe even a crash, in which gold traditionally plays that role of going up in value and offsetting losses elsewhere in a portfolio. Now, one of the things we run into all the time, if we all knew when that was going to happen, then we'd know when to wait to the last minute and then sell our stocks and before everybody else does, and then buy gold. But none of us have a crystal ball like that. So what we run into so often is that when we tell investors this story, they say, well, I hate to move money from my stocks into gold because I hate to forego these big gains that I'm getting in the stock market. I'm going to lose those gains if I go into gold. And in the past, there was some truth to that gold didn't produce the returns that stocks did. That is no longer the case. And it hasn't been the case for some time. And this has not been widely recognized. And you're not going to hear this from most financial advisors because they don't know it. And I'll give you a couple of numbers that really illustrate this. Since January of last year, so we're talking about 21 months.
21 months.
Over 21 months, gold has increased in value by 106%. The Magnificent Seven, those darlings of the marketplace, have increased 97.5%. So 106% versus 97.5%. Gold has outperformed the Magnificent Seven since January of last year. It's outperformed the S&P 500, the broader S&P 500, 106% to 40.7%. So 2.5 times. So if you had transferred some of your funds in stocks into gold for that hedging purpose to protect your wealth, you would have actually made more money than you would have in the stock market. Now let's look a little more recently. If we look to January 1 of this year, what is the performance of these asset classes? One is gold has increased in value 64% this year since January 1. Bitcoin has increased 18%. So gold has outperformed Bitcoin by 3 times. It's outperformed the Magnificent Seven by 4 times. The Magnificent Seven has increased 17%. The S&P 500 has increased by 13.7%. So again, gold has outperformed those asset classes. And even NVIDIA, that darling of the Magnificent Seven, has increased by 30%, and where gold has increased by 64%. So it's a 2x difference. That is a myth that is really important for investors to understand, is that you are not losing returns by moving money from stocks into gold. Over the last 2 years, you've actually increased, especially this year, you've increased your returns. And so it's sort of the best of both worlds. It's a very different situation. The world of finance has changed dramatically since COVID and since the beginning of this year with tariffs and so many other things changing. The world has changed to the point where gold gives you the opportunity to kind of have your cake and eat it too. You have the protection and also the asset accumulation of wealth during the good times.
Some amazing numbers that you've just given us. If I'm in the index funds, if I'm in the S&P 500, how much should I diversify and put into gold right now?
As you can imagine, there's been a huge reassessment of that during this incredible 2-year gold rally, where we've seen 64% increase this year and more than doubling over the last 2 years. And so there's been a reassessment of that. And the chief investment officer of Morgan Stanley got a lot of attention recently when he recommended that we abandon the old traditional allocations of 60% to stocks and 40% to bonds, to adopt a 60% to stocks, 20% to bonds, and 20% to gold. We're also seeing a number of other top flight advisors who are raising their recommendations for gold to 15 to 25% of a portfolio. Now, within those ranges, it depends on what your goals are, how risk averse you are, how pessimistic or optimistic you are about the number of assets you have. But I think those are appropriate ranges in that area, 15 to 25%.
Good to know. Let's finish with this. You've given us so much information. Give me the top 5 things that our viewers need to know about index funds.
Okay. Index funds, the attraction that probably brought you into them, one is low fees. That's still true. 2 is diversification. That's not true anymore. They're highly concentrated in technology companies, and especially technology companies that are deeply invested in AI. The second thing is that there are forces at work in the marketplace today that are really driving gold prices up. And the world has changed fundamentally, such that gold has become a big asset aggregator. It's competing with the darlings of Wall Street, like Nvidia and the Magnificent Seven, and beating them year after year now. And I think that's very likely to continue in this new world. And so investors need to take another look at their portfolios and really talk to their advisors and have in mind a 15 to 25% allocation to gold, like what's increasingly being advised by some of the top advisors in the world.
Perfect. Great recommendations. Philip Diehl, thanks as always for all that you've done.
Thank you, Mike.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.